Ed, how are you holding up? Welcome.
I'm holding up just fine, thank you.
I mean, what was it, COVID and RSV, and how many different things went wrong with the? It sounds like you had a whopper there.
I had 3 out of 4 of the viruses. I just didn't. I don't want to jinx it. I did not get the flu, but I got the other 3: COVID and RSV, and then pneumonia. But I'm recovering. I feel fine.
Oh my God! All right, God bless. Thank you for joining us. Maybe you, of all people, can make some grand analogy about this and the markets, because you're still steadfastly sort of seeing glass half full here for 2023. Yes. Why? What do you think can go right?
Well, I think we're going to have a soft landing, not a hard landing. The data so far shows no landing. As you know, the real GDP number for the third quarter of last year was solid, and it looks as though we're closer to 4% now, looking at the fourth quarter. So second half of last year, there was no sign of a recession whatsoever, no landing whatsoever. I think the consumers are going to remain resilient. I think that while they may eat into excess savings over the first half of the year, I think wages are going to rise faster than prices. So I think real wages are going to increase. Meanwhile, I think the labor market, as Steve pointed out, still looks pretty strong. And so payroll employment is still going to generate some purchasing power. The housing market's sort of a mixed story. We've got very weak single family, but very strong multifamily. So that's kind of a rolling recession that's going through the housing market. We've had a sort of a rolling recession in the consumer area, where consumers have cut down on spending on goods, and instead they're spending more on services.
True.
So I think the consumer is the key, and I think they're going to hang in there.
And I might say that the whole market is hanging on, and I'll turn to you for this, Steve. Basically, when is the Fed going to stop hiking? I can't tell you how many people, from home building analysts to stock pickers to you name it, they say, I will get more bullish, Steve, when the Fed stops hiking rates. And what is the consensus, the expectation for that at the moment?
Well, the first thing I want to tell you is I always read Ed's stuff, but I believe it more now, because anybody can go through what he just went through and still be optimistic. There's a lot more to that forecast now than maybe there was previously. So I think that's important to add. Let me show you where the disagreement is. Before I get there, guys, if you could pull up the May debate full screen that we created. First of all, they're in pretty good agreement on February and March having 25 basis points. When you get to May, that's when it gets interesting and the market starts to diverge. You have a small percentage think they're going to cut once they reach that 488 level. Another percentage thinks they hold. A larger percentage thinks that they're going to raise another quarter, and another small percentage. So you can see the distribution there of probabilities. Now, one of the reasons it's interesting to think about, Kelly, for the difference between the Fed and the market, if you're a Fed official, you have to go in and write down a number for where you think you're going to be. If you're in the market, you can take small bets on all 4 of those different positions I just showed you, and that's why you get a distribution. It could be one person has all of those bets, or, of course, one person could be betting on one particular outcome. So it's the distribution, the idea that one is modal and the other is not, that is part of the reason for the differential. But really, it comes down to the data between now and May that will be ultimately decisive. We start to get the jobs report on Friday. We have a CPI report next week. And that's where ultimately those continuation of that through May, I think the Fed does go to 488, and then the question becomes 5 or higher, and for how long.